Hi, everyone. This is Your Money Matters. I'm your host, Angela Giroux, and joining me are our experts, Clint Lee and Ted Bauman. Now, some very exciting news for us over here. Clint Lee just closed out his 20th winning trade in a row. He hasn't closed out a single loser. So congratulations to you, Mr. Bullseye, once again. Obviously, your subscribers are very happy. We've been getting a ton of emails. For those of you interested in finding out more about his strategy and, of course, to get in on his next trade, you can click the link above or below. And just as a reminder, Clint has been churning out these winners through all kinds of volatility. We've talked a lot about the threats that the stock market is facing. But Clint Lee is clearly a man who laughs in the face of danger.
Knock on wood. Keep them coming.
What's that?
I said, knock on wood, keep them coming.
Yeah, exactly. Now, today we're actually going to talk a bit more about one of those dangers, inflation. We've touched on it some in other videos, how obviously inflation fears are taking a bite out of growth stocks. We're seeing bond yields rise while growth stocks fall, and that's sort of to be expected. Growth stocks are going to be less attractive when they can only generate cash in the future. But now something strange is happening, and to show you, I'm actually going to pull up a chart. Now, as you'll see here, we have this very strange situation where the actual measured inflation rate is rising, but bond yields are falling, and you can see that in the two lines here. So today I've got two questions for both Ted and Clint. Question number one, WTF, what the heck is going on? And question number two, which is probably more important, how can investors come out ahead of this? So Clint, let's start with you.
I think the F stands for heck, but we'll keep going. I guess let's start with bond yields first and just talk about sort of this reversal we've seen recently. And where we could see those yields go to ultimately, and then some of the reasons behind that. So first, here's just a 10-year or a chart of the 10-year Treasury yield. Going back a year, you can see the big run-up we've had, especially once we hit 2021. You know, that uptrend really accelerated. But now, since really about March, we've been trading in sort of the sideways trading range. You can see that with the green box on here. We really haven't gone nowhere until just recently. Now, you know, I think the big expectation among investors was that we would break out of the upper end of this range, that we would keep seeing Treasury yields climb because of, you know, the chart you're showing with inflation, but we've actually reversed lower. So we've broken out of the lower end of this range, and there's a couple targets I have on here. I think initially I'd be looking at the 1.4% level that we could fall to. That's the first or the higher dash line on this chart. There's some minor price support back there, but ultimately I would expect that to give way, and that we would ultimately start to target the 1.2% level. So that's the lower dash line on here. There's a couple reasons for that. One, that was a more significant area of resistance, kind of going back. If you look at where that dash line starts, we had a gap up, a jump over that resistance. That makes it all the more meaningful and important to come back and test that. But you also have the green line coming up there. That's the 200-day moving average. So my expectation is that those two things in combination are kind of like gravity that'll keep pulling rates down ultimately to that 1.2% level. And you've seen confirming indicators as well with other technicals. So we got the MACD and the middle pane in this chart turning lower, and then the RSI, the relative strength index, the green line in the bottom panel, had actually, you know, broke through sort of this support line it carved out, as I'm showing with this dash line on here. So just more evidence that you should expect to see some more downside in yields. And that is a very counterintuitive thing to be thinking about, especially in this last week when we saw the CPI report come out. I've never seen, at least in recent memory, such a highly anticipated report on inflation. And it didn't disappoint for those looking for inflation. It was printed 5% year over year. That's the most inflation, the highest level we've seen at least 13 years, go back to 2008. So what's with the move lower in yields? Well, I think at least for starters, a big thing is just what the one thing that the Fed has done extremely well has been sticking to their script that inflation is going to be transitory. That's just this temporary phenomenon. And you're starting to see economists are buying into that. And now you're starting to see the market buy into that as well. And I'll show you what I mean with this chart right here. So this chart, this comes from Bloomberg, and this has different forecasts for inflation. And I'll walk through each one just really quick. So this is how those forecasts have trended throughout this year. And so if we start with the black line is economist estimates for inflation at the end of this year. And you can see that line has been steadily growing throughout the year. So that expectation that inflation is ramping up, we're seeing that reflected in this number. But then take a look at this pinkish red line. This is economist estimates for inflation at the end of 2022. And you can see that line has barely budged. It really hasn't gone anywhere. So that's a reflection that economists are buying in to what the Fed's saying, that inflation is only temporary. We'll see it this year, and then it kind of goes away. And we go back to these more average or below average numbers. And now you're starting to finally see markets come around to that line of thinking as well. And so that's what the blue line on here. The blue line is sort of the market implied level of average inflation over the next 5 years. And after steadily climbing throughout this year, just over the last month or so, we've seen that trend lower as well. So, markets are buying into what the Fed's been saying all along. And that's one of the reasons you're seeing this dip lower in treasury yields.
All right. So Ted, if we could just kind of peek behind the curtain a little bit and see what's driving this situation.
Well, Clint's right. I think Fed jawboning, as they call it, is certainly one of the elements, because the Fed has been consistent. We're not going to raise rates, folks. We're not going to raise rates. And now they believe it. But there's another thing here. I mean, there are two components to this inflation. One is something that everybody predicted, and like goldfish, everybody's forgot about. And that is that the base effect, in other words, the prices against which we are comparing year on year growth were very low a year ago because of COVID. Companies were shutting down left and right. They were lowering prices to try to maintain cash flow. People weren't going out and buying. So is it a surprise that we get 5% inflation in certain sectors? Not to me. So that's the one piece. The other piece, of course, is that there were supply bottlenecks, right? I mean, basically people stopped making things. Semiconductor manufacturers, for example, shut down their operations because they didn't see how people were going to be buying their products if COVID was going to run rampant. Of course, it turned out that we found a vaccine, and that's all different, but they still have to catch up. So all this is transitory, as they call it. But that's only part of it. That's the actual inflation. The background fear here is government spending in the United States. Basically, the idea that the government has sent out a lot of stimulus money. They're not talking about more stimulus money, but there's this argument that a lot of it is out there and it's pent up and it's waiting to explode into new spending. But I think the critical thing is actually all along been plans for future spending, as I spoke about on Friday in my video, particularly on infrastructure. The idea would be that if the government spends, $1.5 trillion or up to $2 trillion on infrastructure over the next 5 years, that could lead to inflation. But what's happening? It's not going to happen. It doesn't look like it's going to happen at anywhere near that scale, and it's because of this. Here's a headline from this morning about what they're calling the Manchin rally, and basically the rise in bond prices, the drop in yields. This is what I said on Friday, that basically I think people are coming to realize that this is probably not going to be as big a deal as people thought. We're not going to have the big economic boost that comes from a big infrastructure bill, thanks to this man's unwillingness to sign on and all that kind of stuff. And markets are starting to say, okay, well, it looks like that threat has receded, so we can rely on the Fed's idea about the inflation being temporary, and we can go back to business as usual, pumping up growth stocks that won't make a profit for another 5 or 10 years, and we'll all play that game again. So I think that's a big part of it. But there's another piece which is very much hidden, and it could actually be transitory. And that is that there are technical developments in the treasury bond market that are putting downward pressure on yields. The first one is that quantitative easing, when the Fed pumps money into the markets, they're doing it by buying treasury bonds out of the market, right? Which means that if there's a demand for those treasury bonds for any reason, that means that there's reduced supply, which makes their price go up, which makes bond yields fall. Now, normally that would be taken care of when the Treasury issues new long-term Treasury bonds, like a 10 or a 30-year. But right now, the general operations account of the Treasury Department has more than $500 billion in it. So the bonds that they're issuing are all short-term, and those are not the ones that the market wants. So there's still a shortage of longer-term bonds, 10s and 30s. And so that means that relative to the demand for them, there is a reduced supply, which means that the prices are going up. Now that's reflected in another very interesting development. It's a little arcane, but it's happening and it's weird. And that is that you're finding that there are participants in the bond market who are willing basically to pay somebody else to lend them a bond against cash. In other words, they're willing to pay a negative interest rate. In other words, pay somebody to let them get their hands on a bond. Why would they do that? Because they've been shorting bonds, right? So what's happened here is that people thought inflation was coming. So some smart guys said, well, let's short Treasury bonds. Now, they don't always own those bonds, of course. If they're shorting, by definition, they don't. Now that rates are starting to fall again, basically the rates are falling, that means that they have to cover those short bets. They have to acquire bonds to pay back, to cover the short bets that they've made. And that creates a big demand for those bonds. And that's, again, pressure upwards on price and downwards on interest rates. Now, that's a short-term factor, but it's an important one, because if it carries on like this, if you get those two things working in tandem, the reduced expectations of government spending and this sort of stuff going on in the bond market, then yeah, we could see interest rates stay pretty low for the rest of the year.
Sounds like bonds are the newest meme play.
Well, we'll see. We'll see. I mean, that would be interesting. That would be very interesting.
So this brings up the big question, of course. How do we play this? Clint, I'll start with you.
Yeah, I mean, you talked at the very beginning about the connection between rising yields and the impact that was having on growth stocks, a negative impact. Well, the same is going to be true in reverse. As yields start to fall, I think you can be selective in looking at some areas of the growth market for opportunities. And one that stands out to me is in the cybersecurity space. So if you look at there's a NASDAQ cybersecurity ETF, the ticker CIBR. When you look at sort of the valuation components, it's not as extreme as some areas of the growth market. I think that the median holding in there, the price to sales ratio is just over, down here is just over 5.4 times. That compares to the S&P of about 3 times. So it's expensive, but it's not crazy expensive. But when you look at earnings growth, the earnings growth for companies in this ETF on a median basis are expected to put up about 23% over the coming year. So you're getting a lot of growth. Valuation can be supported if we continue to see yields fall here. But then what I really like about CIBR is the chart setup and the recent breakout we're seeing. So here's a chart of the ETF. And, on the left-hand side, we had this huge run up in price. And really since about December, January, we've been consolidating those gains just by trading sideways. But we kept narrowing that trading range. That's what I'm showing with the two trend lines drawn on here. You sort of had this almost triangle-like pattern that's finally breaking out to the upside. And you're seeing a lot of support too with other technical indicators like the MACD just turning positive from close to that zero line, and RSI as well. You got RSI breaking through sort of this downtrend resistance. So that to me supports the breakout that we've had CIBR, and I would be looking to a move to new all-time highs here after this.
Ted, any ideas?
Yeah, well, usually I'm the fundamentals guy and Clint's the technicals guy, but he's just given a fundamentals argument. I think growing revenue for cybersecurity. Now I'm going to give you a technical argument. There's an ETF called the Direction Moonshot Innovators ETF, called Moon, that's the ticker. And it holds a lot of companies, particularly in biopharmaceuticals and other, it's like they say, moonshot. It's basically speculative companies that could generate massive growth if things go right for them. And I've got a chart here just to show you its prior highs, which was really back in February this year. So if you look at the trend, I mean, it started to pick up a lot of steam since mid-May. It's risen quite substantially from about a $30 level to about a $38 level, but it could get back up to 50. So if you've got a very short-term perspective and you want to kind of bet that if interest rates keep falling and people get reinterested in this stuff, they could push it back up to 50, which is a pretty tidy short-term gain. But I would probably take profits at that point and just wait and see if it continues to grow. So that's a very short-term one. But I want to say one last thing, and that is that what we're doing in the Bauman Letter right now is actually the opposite of all of this, and that is we're looking for cash flow. Because I'm not convinced that we have a stable path forward for the market right now. So the second thing I'm doing is really focusing on real estate, and particularly real estate investment trusts. And I got two charts I want to show you. One is that shows that right now the fastest growth in free cash flow yield, which is where dividends come from, is in real estate. It's grown by 4.5% year on year. So that's tremendous opportunity there if you're looking for cash income through dividends. Here's a chart that shows that same performance over time. That's probably the steepest uptick that we've seen since essentially back in the days of before the great financial crisis. So my final point is, sure, play the technicals on the bond market, a yield question short term, but don't forget to put some money into the long term, the basic stuff, which is what we've been doing in the Bauman Letter.
Great reminder, and that provides you viewers with several options here. We gave you 2 ETFs, REITs, and of course the opportunity to join Clint Lee in Flashpoint Fortunes. Thank you so much for watching. Ted and Clint, I will see you next week.
Thank you.